Hello, today let us look at discount received. And discount received is basically a reduction given by a supplier when a business pays its debt early, okay? And it arises on credit purchases. For example, if I go to a shop and I find that a phone is being sold at 10,000 and they sell to me on credit and tell me, okay, by 5th of the following month, if you pay this phone by the 5th of the following month, I'm going to give you we are going to give you a 5% discount, okay? So this 5% discount is what is referred to as discount allowed to the supplier, okay? And it is what is also referred to as discount received to the customer. So I, as a person who has bought this phone, I'm going to get the discount. I'm going to receive the discount. So in my books, I'm going to account for discount received because I'm the one who has received this discount. On the other end, on the supplier's books, they're going to account for discount allowed because they are the ones who have allowed for this discount. Okay. Another thing to note is discount received is considered as a gain to the business because it's going to save you money. You were supposed to pay 10,000, but if you pay early, now for instance, if I go and pay early, I'm going to pay less 5%. So this is considered as a gain and it's like another income to the business. Okay, so let us look at an example. We see how to differentiate between discount allowed and discount received. Okay, so we have KM Traders, which is a small business selling general goods, and these are the transactions that took place during the month of March 2026. Okay, so the first transaction is the owner invested Kenyan shillings 80,000 in cash into the business. Okay, so let us go step by step, recording this in a working TB to see how these transactions we're going to account for till we get to our TB. So the first transaction, we can see it is the owner who is investing. So that is equity and they are investing in cash. So we need to recognize an increase to the cash account. How do we recognize that? We debit that account. Okay, so we debit 80,000. And we also need to recognize an increase to the capital account. And to recognize an increase to the capital account, you credit that account. Okay, so this records the first transaction. The second, the business purchased goods for cash worth 30,000. So they go and buy goods worth of 30,000. So first thing is, you will notice they're going to pay in cash. So cash is going to reduce. How do you recognize a decrease to your cash account, which is an asset account? You credit that account. So on the other end, they are going to be receiving goods worth 30,000. So you record this increase to your inventory account, which is also an asset account. And to recognize an increase to your asset account, you debit that account. Okay, so let us move to the third transaction, which is the business purchased goods on credit worth 20,000. So first thing, there is an increase to your inventory again, which we debit that account by 20,000. And this time round, we are buying on credit. So we need to recognize an amount that is payable to this supplier we have bought from. How do you recognize a liability because an account payable is a liability account? You credit that account. So we credit 20,000 to the account payable. Okay. Then for the fourth transaction, the business sold these goods on credit, sold goods on credit for Kenyan shillings 25,000, and the cost of goods that they sold was Kenyan shillings 15,000. First, we need to recognize this sale. Okay, so the sale is 25,000. So we need to recognize an increase to the sales account. And to recognize an increase to the sales account, what do? You credit that account. We are crediting 25,000. And the other thing you need to note is these goods were sold on credit. So we have an amount that we're expecting to be paid. So we need to recognize an increase to an account receivable because we are expecting to receive this money from the client we have sold to. So you credit that account by 25,000. 20,000. Note that an account receivable is an asset account, so to increase it, you debit. Okay, so the other thing you need to notice, to recognize once you do a sale, is you need to recognize the cost of goods. And we are being told our cost of goods is 15,000. Okay, so you need to recognize that expense. Cost of goods is basically an expense of those goods that you have sold. So you to recognize an increase to your expense account, you usually debit that account. Okay, and then to recognize a decrease to your inventory account, because now inventory of worth 50,000 has been sold to someone. So what do? You credit that account. You credit inventory account to reduce the inventory that you had before. Okay, so let us look at the fifth transaction, where this customer now settles the amount within the discounted period, and it was allowed a 4% discount. Okay, so let us first calculate the discount that they were allowed, which is 4% of 25,000. Remember, we sold the goods at 25,000, and you're going to see this is 1,000. Okay, so the client paid 25,000 minus 1,000. So they paid, and the business received cash of amount 24,000. Okay, so one thing you need to recognize as well, this discount allowed. Discount allowed is an expense to the business. So to recognize an increase to your expense account, what do? You debit as well. So you're going to see, we're going to have 24,000 plus 1,000, that is going to balance us 25,000. On the other side, what is happening is we have been paid what we were expecting, or what we were expecting from this client. So we need to reduce our account receivable. So we come and credit the account receivable. Don't forget to decrease an asset account. What do? You credit that account. Okay, and then for the sixth transaction is the business paid the supplier Kenyan shillings 19,000 in full settlement of the debt, receiving Kenyan shillings 1,000 discount. Okay, remember we had purchased some goods on credit, if you can remember, on transaction number 3. So we paid and we received a discount of 1,000. Okay, so first paying, we paid 19,000, which is a decrease to our account because we are paying the supplier. So credit 19,000. So one thing you need to note, you're also getting a discount from this, okay, which is saving you 1,000. And that is what we call now a discount received, because we are receiving it now from the supplier. And as I mentioned earlier, discount received is like a revenue. It is a gain to the business. Okay, so how do you record an increase to your revenue account? You credit that account. So we are going to credit 1,000 to the account received, to the discount received. Okay, and then on the other end, we have to reduce our account payable. Okay, because now we have paid this supplier. Okay, so you come and debit the account payable, because now we want to reduce that account. When you want to reduce a liability account, what do? You debit that account. Okay, so let us look at the last transaction, which is the business paid rent of Kenyan shillings 8,000 in cash. So we need to recognize an increase to our rent expense account. By doing what? We debit that account. Why? Because when we want to increase an expense account, we debit it. And what is happening? We are paying in cash. So we need to recognize a decrease to that, to the cash account by 8,000. Okay, now let us look at the balances here. So 80,000 minus 30,000 plus 20 minus 19, then minus 8,000 will give us 47,000. Okay, then we have 30,000 plus 20 minus 15 will give us 35,000. Okay, then we have 25 minus 25 is going to give us a 0 balance. Discount received, we have a credit amount of 1,000. Okay. For rent expense, we have an account balance of 80,000. 8,000. Then for the cost of goods, we have a balance of 15,000. Then for discount allowed, we have a balance of 1,000. And then for capital, we have a credit value of 80,000. Then for sales, we have a credit amount balance of 25,000. And then for the accounts payable, we have it balances out as a 0 balance. Okay, so now let us look at our TB. How will it look like? And as always, remember to write your trial balance as at a certain end period. Okay, this is very key. Okay, so what is the cash balance? The cash balance is 47,000. Okay, so 47,000, which of the cash account is a debit account. Okay, and then we have inventory of 35,000. Then we have cost of goods. Cost of goods balance, we have 15,000. Don't forget, cost of goods is an expense account, so this is also on the debit side. Always refer to the dealer. Okay, dealer, this is what is usually the credit. This is the debits. These are the debits account. Okay, remember the expanded accounting equation. Okay, so our rent expense, we have a balance of 8,000. Still, an expense account is on the credit side. This is what is the expense, and this side usually as equity. Okay, and then what is our balance for the discount allowed? We have 1,000 discount allowed, which as mentioned earlier is an expense. It's an expense account. Then we have capital, which is 80,000. It's a liability. It is an equity, so it's on the right side. Okay, then that is on the credits. And then sales, which is revenue, it has a balance of 25,000. Then we have discount received with 1,000. Okay, 1,000. And then when we sum these, we are going to have a total of 106,000. And on the other end, 5 plus 1, we're going to have a 106,000. Okay, this means our TB is balanced. So note that discount allowed is what the supplier, records in their books. Okay, and then discount received is what the customer records in their book for a particular discount that is given. Okay.